When you hear balance sheet, do you tune out? It sounds complex, like a secret language for accountants. But what if it's actually a simple story about a company's financial health? The balance sheet is built on one core idea, and in the next few minutes, I'll show you how its three key parts reveal everything and how easy it is to understand. The balance sheet follows one unbreakable rule: assets equals liabilities plus equity. That's the entire foundation. Think of it as a financial snapshot, capturing exactly what a company owns and owes on a specific day. On one side, assets, everything valuable the company owns. On the other, how it paid for them, either with borrowed money, liabilities, or the owner's money, equity. And here's the key: those two sides must always be equal. They have to balance. Section 1. Assets, what a company owns. Assets are valuable resources a company owns that provide future benefit. They're split into two groups based on liquidity, how fast they can become cash. Current assets are used or converted to cash within a year. Cash, money in the bank. Accounts receivable, money owed to the company by customers. Inventory, products waiting to be sold. Prepaid expenses, paying for something like insurance in advance. Non-current assets or long-term assets stick around for more than a year. Property, plant, and equipment, big physical stuff like buildings, machinery, and vehicles. Intangible assets, valuable things you can't touch like patents, copyrights, and brand reputation, goodwill. Long-term investments, investments in other companies held for over a year. Add them all up and you get total assets. Section 2. Liabilities, what a company owes. Liabilities are what a company owes to others, its debts. Like assets, they're split by when they're due. Current liabilities must be paid within 1 year. Accounts payable, money the company owes to its suppliers. Short-term loans, debt due within 12 months. Accrued expenses, expenses incurred but not yet paid, like employee wages. Unearned revenue, money from customers for services not yet provided, like a subscription. Non-current liabilities are due in more than a year. Long-term debt, large bank loans or bonds. Lease obligations, future payments for long-term leases on buildings or equipment. Summing these gives you total liabilities. We've covered what a company owns and what it owes. Next is equity. If this is helping, hit subscribe so you don't miss our next financial breakdown. Section 3. Equity, what the owners own. Equity is the final piece. It's what's left over for the owners. The simplest way to see it is by rearranging our formula. Assets liabilities equals equity. It's the net value of the business belonging to its owners. Equity's main ingredients are capital contributions, the original money owners put in to start the business. Retained earnings, profits the company has reinvested in itself instead of paying out. Liabilities and equity are the two sources of funding for all the company's assets. Section 4. The full picture, a real-world example. Let's look at a coffee shop's balance sheet. Asset side. Cash, $5,000. Inventory, $1,500. Espresso machine, $10,000. Total assets, $16,500. Liabilities and equity side. Money owed to suppliers, accounts payable, $1,000. Bank loan for machine, $6,000. Total liabilities, $7,000. Wait, $16,500 in assets doesn't equal $7,000 in liabilities. We're missing equity. Remember, assets, liabilities, equity. So $16,500 minus $7,000 equals $9,500. That's the owner's equity. Now, does assets equals liabilities equity? 16,500 equals 7 abilities plus 9,500 equity. 16,500, 16,500. And that's the balance sheet. Not so scary, right? It's a story in 3 parts: what a company owns, assets; what it owes, liabilities; and what's left for the owners, equity. By understanding that assets equals liabilities plus equity, you have a powerful tool to see a company's financial stability at a glance. This is the first step. The balance sheet works with the income statement and cash flow statement to tell the full story. To learn about the next piece, check out our video on the income statement. Thanks for watching, and subscribe for more finance tutorials.